Welcome everyone to episode 2 of The Noble View with myself, Michelle Siegel, and Daniel Millman, CEO of Noblestone Capital. Hi Daniel.
Hi Michelle.
It's great to be back here. Let's talk about how the election will affect public markets, stocks and bonds.
All right.
So let's start with the bond market. What do you think about bonds going forward?
So we talked about a lower interest rate environment going forward, both because of lower inflation expectations as well as a more active Fed. Both of these things imply lower interest rates for bonds, lower yields, which means that they'll return less and be a less attractive asset class going forward. Additionally, in terms of within the asset class, so I think you see a move over time from safer bonds like treasuries to higher yielding bonds, corporates, and lower than investment grade corporates, junk bonds, which means that the asset class itself will become as a whole more risky. So I think the overall takeaway for bonds is that they become less of a effective diversifier than they were before.
Okay, moving on to stocks. How do you think the election affects the market?
Yeah, so if you look at the economic takeaways that we talked about last time, there are a lot of positives for stocks. First of all, a lower interest rate environment again, more moderate inflation expectations, stronger global trade, and a weaker dollar are all positive for stocks, both in the US and globally. Additionally, we talked about political gridlock, which again is our base case. So if you look at history since World War II, and you compare times when you had split governments versus when either party was in complete control, what you see is that when governments are split, the stock market actually performs significantly better than when either party is in complete control. So I think overall, our takeaways for stocks are positive.
Okay, so what sectors do you think benefit most from the election?
So there are really two that stand out for me, healthcare and big tech. So healthcare was at particular risk of drug price legislation as well as changes in healthcare law with a blue wave, both of which I think are significantly less likely right now. And that's a big win for the sector. And I think that if you look at valuations, the sector also seems to be valued attractively. So I definitely like healthcare. And big tech was at particular risk of antitrust legislation, which is also much less likely now, although we do see some of that in Europe. Even if we do see it, I think it'll be less severe. So I think that big tech is a winner as well.
That's interesting. So what sectors do you think are losing out over here?
So banks really stick out to me. With lower interest rates over time, banks' profit margins are compressed, and I think that hurts their profitability over time. So if I had to pick a losing sector, I'd call it the banking sector.
And what about commodities?
So commodities are actually interesting because you have both positives and negatives, right? You have a weaker dollar, which is definitely positive for commodity prices. But at the same time, you have more moderate inflation expectations, which is actually a negative for commodities, and particularly commodities that are historically inflation hedges like gold. So I'd say it's kind of a mixed bag for commodities. So I think that I'd say that the overall outcome is kind of neutral.
Thank you for that. That was really interesting. But what about the real estate market? Stay tuned and join us next time on The Noble View.